Good morning everyone, I'm Ken, financial analyst from Regain Capital, and welcome to our morning market briefing on the 23rd of November, Monday. So as usual, in our market briefing, we will cover three parts, namely the fundamentals, the news release, and the technical analysis. So without further ado, let's start off with the fundamentals. When we take a look at last Friday's market movement, we can see that most of the instruments are in a bullish market, with gold rebounding by 0.26%, the pound, the pair of GBP US dollar, climbed higher by 0.16%, the index dollar inched higher by 0.05%, and oil extending gains by 1.68%. So let's get into details with the headlines of today. First off, let's discuss on gold, where we can see precious gold suffered a second weekly losses overall, while trading below the key 1900 resistance level. Now, the demand for the safe haven gold were falling following investors' risk appetite as they anticipate a vaccine to ease economic worries. Now, although gold prices remain supported by loose monetary and fiscal policies globally, the recent stall in the US stimulus had prevented gold to revisit its highest level in August, near the 2000 handle. Now, if the vaccine shows more promising results before the next round of the US stimulus, we can see that the gold short-term outlook might point towards the 200 moving average support in the daily chart near 1830, where we'll cover more on the technical front later on. So overall, investors are waiting for a bullish confirmation, which is the breakout back above the 1900 key resistance level. Now, failure to do so, investors will most likely enter into riskier assets, following the recent risk appetite in the market, and that could see gold prices falling back to its low level reached last week near 1850. So instruments involved here would be gold itself. Moving on, let's talk about the dollar, where we can see that the dollar index had been trading between the 92 handle and the 94.5 since the month of August, denying to break any lower but also unable to extend higher. So the mixed trading in the dollar can be explained by the recent market signal. Now, from the risk-on perspective, news on the possible vaccine had boosted optimism of a stronger economic recovery, and that has actually pressured onto the dollar. However, with the record rising number of new COVID-19 infections across the world, especially in the US and across European countries, the sentiment continues to be pointed towards a crippled economic recovery expectations. Furthermore, we also have the latest dispute between the US government and Federal Reserve in their effort to aid the economy, where we have discussed last Friday, where US Treasury Secretary Steve Mnuchin had requested the Fed to return all the loans provided by the Fed, which is originally used and targeted for the Fed's lending program to help the economy. So after the revoke of this program, we will see how both the government and the central bank would work together in order to further support the US economy, especially when the US stimulus is being stalled and many citizens in America are in desperate need of the money. So instruments involved here would be dollar index itself. Moving on, let's take a look at the news release for today. So please take note, time stated here are at GMT plus 8. So the first data would be 4:30 from the Eurozone, where both Germany and French will be releasing their manufacturing PMI and the services PMI. However, it is not stated here, as France focuses more on the services sector, while Germany focuses more on the manufacturing sector. So for the German manufacturing PMI, it is expected to fall lower from previous month of 58.2 to 56.5. Whereas for the French services PMI, expected to fall from previous month of 46.5 to 39.2. So the forecast to fall lower than the previous month is most likely affected by the rising number of COVID-19 infections, which had weakened the market sentiment in the euro. So overall, for both of the PMI data, any reading below the forecasted value would exert pressure onto the euro. And at 5:30 would be UK's manufacturing PMI and its services PMI together with the composite PMI. So overall, both the manufacturing and services PMI is expected to remain same at 52.3. So any reading difference than the forecast value would actually impact onto the pound, but the effect will be less than usual. This is mostly due to the sentiment in the pound, where most investors are waiting for the results of the Brexit negotiations. So investors who are trading for the pound can focus on any breakout or any breaking news on the Brexit, where it is most likely to bring large impact onto the currency. So that's all for the news release. Moving on, let's take a look at our technicals. So here's an overview of instruments to be covered. First off, GBP US dollar H4 showing an uptrend, Euro Canadian dollar H4 showing a downtrend, US dollar Japanese yen H4 downtrend, and for gold in its H4 chart also in a downtrend. So let's get into clearer details with the chart analysis, starting with the pound. So overall, we can see that the pound has successfully broken above the previous resistance at 1.3260 we've covered previously, and right now is targeting towards the resistance, previous resistance one at 1.3310, and a further resistance would be towards here near 1.3380. So if we're looking at the daily chart, we can see the resistance zone is somewhere around here. So the final resistance would be the previous high reached in August near 1.34. So overall, right now, as the pair breaks above the resistance at 1.3310, MACD also signaling a bullish momentum, suggests the pair to extend higher all the way towards the resistance at 1.3380, or even further would be the psychological level at 1.3400. So investors can consider entering into long positions at the current level 1.3320. Stop loss should be placed 40 pips from the level at 1.3280, and a take profit targeted all the way towards the resistance level at 1.3400. So overall, we can see that the sentiment for the market for the GBP US dollar is still in a strong bullish momentum. However, as I mentioned just now, please take note of the any breaking news regarding Brexit, as that could cause the currency to move in either direction. So an optimism for a Brexit deal or the reaching of a deal might give a strong support for the GBP US dollar, and whereas for a no deal scenario, that would send the pound falling into its lowest level, possibly all the way towards the 200 moving average, as bound back towards the 1.2 levels. Next, for the Euro Canadian dollar and the H4 chart. Now overall, we can still see a downtrend forming over here and constructing the Fibonacci from the previous high towards the low. We can see that overall the pair has been trading between the 50.0 Fibonacci and 38.2 Fibonacci, unable to break from either side. So overall, cautious investors are advised to follow the trend, which is overall still a downtrend. The pair might most likely face some rebound all the way back towards the downward trend line before continuing its movement lower. So cautious investors are advised to wait for a rebound back towards the 61.8 Fibonacci near 1.5570 to enter into short positions. Stop loss should be placed 30 pips at 1.5600, and the take profit from the entry point could be all the way towards below the 50.0 Fibonacci near 1.5510. However, for aggressive investors, you can consider entering into a short positions at the current market price in anticipation that the pair is unable to break above the 50.0 Fibonacci. So aggressive investors can consider short positions at 1.5520. Stop loss should be placed 30 pips at 1.5550, and a take profit first targeted at the 38.2 near 1.5480, or even a further target would be the 23.6 Fibonacci near 1.5430. Next, for the pair of US dollar Japanese yen. Now constructing the Fibonacci from the previous high towards the low, we can see that the pair has been trading below the 23.6, where usually a breakout above the 23.6 would signal a possible change in trend. However, failure to break above suggests the pair to continue its trading in a downtrend. So overall, investors can consider short positions at the current level 103.75. Stop loss should be placed for the Japanese yen. We will be looking into a longer term movement. So for the stop loss should be placed 40 pips from the level at 104.2 to be safe, or even higher, 104.3 above the 38.2 Fibonacci level. Whereas the take profit can be targeted all the way to the lowest level at the 0.0 Fibonacci near 103.2. However, if the pair does breaks back above the 3.6 Fibonacci, investors should then consider long positions. Stop loss should be placed 30 pips from the entry point, and a take profit targeted all the way to the 38.2 Fibonacci at 104.3. Lastly, for gold and the H4 chart. Now, constructing the Fibonacci from the previous high over here towards the low, we can see that overall trading for the gold has been supported by the support level near 1860, and we can see that the gold has been trying to break the support of 1860 for countless time 1, 2, 3 and 4, and now finally leaving a long shadow below, and now trading back towards the 23.6 to await for a breakout confirmation to signal a possible change in the trend back to a bullish trend for the gold. Now MACD also signaling a bullish momentum together with a formation of a positive divergence, where we can see momentum building higher over here, whereas prices were falling lower overall. And so following this positive divergence signal, aggressive investors can consider long positions at 1873. Stop loss should be placed below the 1860 support, and a take profit can be targeted all the way to the 38.2 Fibonacci near 1895. So, however, for cautious investors, you are advised to wait for the breakout above the 23.6 as a confirmation of a change in trend before entering into long positions for the gold. So entry point should be around 1880. Stop loss can be placed 50 pips from the level at 1875, and a take profit targeted about 100 pips all the way to its 1890, or further target would be 1895 near the 38.2 Fibonacci. So that is all for our market briefing. Please remember to follow us on our social media such as Facebook, Telegram, Twitter, as well as Instagram, and feel free to drop by our website at www.regaincapital.com to get updated on all the latest market news as well as education posts for our clients. So thank you all for listening. We'll see you next time on our market briefing, and happy trading to all.